In this video, we're going to answer some of the most common questions that we get as financial advisors around group RSPs, specifically in that right before retirement and right after retirement period, just around retirement. So if you're thinking about retiring soon, or you're already retired and you're a little bit overwhelmed about coordinating all the accounts and figuring all that out, I think this video is going to be really, really helpful. Shaun, you often refer to group RSPs when talking to clients as the forgotten account. Maybe unpack what you mean by that a little bit.
Yeah, talk about the forgotten account or the orphan account. What I mean by that is I tend to find that clients are pretty heavily invested in monitoring their own personal accounts. If they've got their own individual RSP, maybe they're working with their financial institution or broker or advisor. But the group plans that they might have almost tend to be like an afterthought. It's not really on the radar as much for them. And there's a few reasons for that. And we can maybe unpack that a little bit as we go through the video today and the questions. But yeah, it doesn't seem to be connected properly to the overall planning, and it's almost like a last minute decision for a lot of people. They're just not really leaning into the details of their plans.
Yeah. It doesn't feel like it's your problem, right? It's the employer's problem. So I'm not going to really think about it. Yeah. Okay. So I'm just going to shoot off some questions at you, and then you can illuminate some of these common questions we get. So the first question is, what happens to my group RSP when I retire? And kind of to piggyback off that, does it stay with the employer, plan provider? Do I need to transfer it out to a RRIF? And is there a deadline? So you can kind of go through those as you want.
Yeah. So the first two is kind of all of the above. So does it stay with the employer and the plan provider? It can. So very often when you're getting close to retirement and let's say you begin looking at your options, one of the options for most group RSPs, so some of the big carriers out there might be Canada Life or Sun Life, some of the large insurance companies and group benefits plans. And so they'll actually work hard to convince you that it might be a good idea to keep it with a group plan. And in that situation, it goes from a group RSP to an individual RSP. And so it can still sort of be in the satellite of the financial institution, again, like Sun Life or Canada Life, and you can maintain your financial assets and investments with them. So do I need to transfer it to my personal RSP or RRIF? No, you don't have to. So typically you have the option to keep it with the plan sponsor or the institution providing the benefits. We can talk through this discussion today as to why you would want to consider transferring those benefits that you've accrued to your own personal accounts, but you can go either way. You can keep it there or you can move it to your own personal plan.
Yeah, we'll get to, I think, that whether or not there's pros and cons to keeping it there or moving it in a second here. So
yeah, and I think that, you did ask a question about the deadline. Theoretically, there's a deadline. I mean, the deadline is going to be really tied to your retirement date with your employer, right? So they're going to give you a package, and in that package, that's when you need to begin making your election options. Do I keep it with my current group plan and move it to an individual plan with that company, or do I transfer it?
Awesome. All right, so moving on, do I need to convert my group RSP to a RRIF immediately? Or can I leave it as is for a little bit after retirement? And also, when do minimum withdrawals from a RRIF begin?
Yeah. So again, if you've being a student of this a little bit, like if you're beginning to research how RRIFs work, you can leave it. You can leave it as is for quite a few years, often for people after retirement. So it'll go from a group RSP plan to an individual RSP plan. Let's say that you're 60 when you made that decision. Under legislation, you don't have to convert that money to a RRIF until your 71st year, and you don't have to take your first payment until your 72nd year. So you can defer moving into a RRIF, and then at some point, your age 71, you have to make that conversion election. And that ties into the second question that you asked, Josh, is when do minimum withdrawals from the RRIF begin? Again, it just depends on when you make that conversion from the RSP plan to the RRIF plan. Now, our experience has been the majority of our clients will make an election conversion from an RSP plan to a RRIF plan before age 71. So most people need income from their accounts before age 71. And what also happens, and again, we may get into this in the video in a little more detail later on possibly, but what we encourage clients to do, notwithstanding their decisions around their group RSP, let's say they really like Canada Life, they keep it there and move into an individual plan. We do see and encourage clients to consolidate their RSP assets to one RRIF account eventually. Because the big difference when you retire is now you're administering income payments, and there's a little bit more administration. There's decisions around taxes and that kind of thing. And it can get too complicated if you're managing multiple RRIFs, right? Your group plan goes to an individual plan, and that's a RRIF. Then you have your personal RSP, that goes to a RRIF, right? And now you're dealing with multiple accounts, and if you've got a partner, they might have one or two. So it ends up being a bit of a hassle for people.
Yeah. All right, transfer options. Now, I'm ready to transfer my group RSP. Can I transfer it to a self-directed RSP or RRIF or with my own advisor? And if I'm transferring it, are there any fees on top of what I'm already paying or penalties for transferring?
Yeah, it's a great question. So again, it depends. And so generally speaking, if you want to transfer to your own self-directed RSP or your advisor, it's a mixed bag. What can happen with many institutions is they're using proprietary investments for the group plan. And you may not necessarily be able to move those same investments to your self-directed RSP or your advisor. Now, one of the reasons that many clients will deal with advisors who are licensed on the security side is they like the flexibility that their advisor can handle any investment. Or if they have a self-directed RSP and they're managing it themselves, again, they can hold any eligible investment in that account. But that's not necessarily the case with your group plan. Your group plan is with one manufacturer typically. Again, we'll use the example of Sun Life or Canada Life, and you're using their proprietary services. And often those accounts cannot be transferred as is to your individual account or to your advisor. What has to happen usually is a redemption, right? You move to cash within the group plan. It doesn't trigger any tax. There's no issues there. And then it goes tax deferred to your own self-directed RSP plan or to your financial advisor that you're working with. So that money goes tax deferred. There's no tax triggered, but it goes as a cash transfer. And then the money has to be reinvested once it reaches your self-directed account or the account that your advisor's working on with you. And that's one of the downsides of group plans. It sometimes forces this decision. You know, you could have circumstances where you really do not want to redeem money. So let's say that the market's down on your group plan and you're down, let's say 15%. And the only way that you can move money to your own individual plan or advisor is to do it as a cash transfer. Now you've triggered a loss that you really didn't want to trigger. And so that's why, and we may talk about this in more detail, one of the things you want to be looking at with your group plans is, do I need to be a little intentional, proactive on how I handle the investment mix? Because I want to minimize the chance that I have to sell something at a loss. And if I'm too aggressive with my portfolio, that could potentially happen.
Yeah, no, that's really good. All right, moving on to everyone's favorite topic. What are the tax implications when I withdraw from my RSP or RRIF? So what are the withdrawals taxed, or how are they taxed? And how do I avoid a sudden large tax bill in one single year?
Yeah, so again, a good question. So again, I'm not going to make any assumptions here, but I'm going to make this comment that obviously if the money goes from the group RSP to an individual RSP or individual RRIF, that first transfer, there's no tax on that transfer. That's tax deferred. Now it's in your RSP or your RRIF and you want to take some money out. And you can do that both with a RRIF and an RSP account. And if I do it with my RSP account or RRIF, what's going to happen is, we'll start with RSPs first. Up to $5,000, there's a 10% statutory tax. From 5 to 15, there's 20%, and above 15, there's a 30% tax rate. That's going to be held back. When you redeem the money, the financial institution you're dealing with has to remit that to CRA, and then you'll get the net amount paid out to your bank account as an example. The issue around the tax withholding, I think for most people, if it ends up being 20%, their effective tax rate probably is going to be around 20%. So it's unlikely they're going to have to pay more tax. For some people, they might get a refund back depending on the holdback. The one exception to that is with a RRIF account, we have something called the RRIF minimum. And the RRIF minimum is calculated using a formula. It's basically 1/90 minus your age times the opening value of your RRIF account that year. And that gives you the percentage that has to be taken out as a RRIF minimum, right? So that minimum payment, there's no requirement for tax to be held back. So it's kind of a mixed blessing. So we do have some clients that go, yeah, I don't want the tax held back. I want to have that money. I want to be able to use it, maybe invest it, and I won't pay the tax due on that RRIF minimum payment until I file 6 months, 7 months, 8 months, 9 months later. So I want to keep the money. I don't want to give it early to CRA because they're not going to pay any interest on that tax payment. My experience with clients is they really don't want any surprises at tax time. So they usually do want, even on their RRIF minimum payments that don't have a statutory requirement for tax held back, they usually say, Shaun, hold back to 20%, let you know our tax situation. And if I have an effective rate of 20%, when you pay out the minimum, hold back to 20%, zip that off to CRA. Because I don't want to have to come up with a $3,000 at tax time to look after that tax bill, right? So
for sure.
So that's sort of the tax piece. And how do you avoid large tax hits in a single year? $1 million question. I mean, if you're watching the videos on our channel, we do a lot of videos on case studies and using our software applications to tax effectively manage cash flow. So if you're doing a fairly consistent drawdown from your RRIF account or RSP accounts in retirement, you can manage that tax hit pretty consistently. There doesn't have to be any large hits in any given year. However, if a surprise expense comes up, then you want to be careful. And that's where the planning comes in. That's why it's helpful to have money in your TFSA account, maybe money in your non-registered account. So a larger than expected expense, normally you don't want to fund that from your RSP or RRIF because of the tax implications. You want to go into your TFSA or into your non-registered, pull the money from there, deal with that expense that way. That's normally what is the best option is. Now, that doesn't mean we have some people who've done that and they go, man, like I really worked hard to get that money in the TFSA and now I pulled the money out. So if you pull it out, in the current calendar year, you can actually put the money back in the following year. So we've had people take money out and then they take not large amounts out of the RRIF, but a little bit larger than normal, as long as they're not bumping into another tax bracket. And they'll take more out, more than what their income needs are. And they use that additional amount to begin pushing money back into their TFSA over time, right? So it's all about tactics. And if the tactics are right, you can really limit the tax hit on those redemptions.
Yeah. And you have I think maybe a couple of weeks ago, you did a video on using your TFSA for those larger expenses in retirement.
Yeah.
I mean, maybe you want a new car, you want to redo your roof, and if you take it out of your RSP, you're gonna have to pay tax on that. So you can use your TFSA tactically and then replace that money you took out in the following year.
And that's where, again, you start connecting those decisions and that planning with your portfolio design. So I'll give you a good example. We have lots of clients when they start building their retirement budget, they'll actually give us, okay, here's my basic non-discretionary, those never change. Here's my discretionary budget. And here's my periodic lump sum expenses are going to come up. And so what we say to the client is, well, some of that money is going to come out of your TFSA because of the tax implications. And because it's going to come out in the next 3 years, normally we say to clients for TFSAs, that's where you want the rocket fuel returns, right? You want your growth portfolio to be in your TFSA to leverage the tax-free compounding. But there are exceptions to the rule. And one of the exceptions is, if I know I'm going to go in and take $40,000 from my TFSA in 3 years for a new vehicle, that needs to be conservatively invested. So you have to be nuanced in your investment decisions because you don't want to be, again, in a minus 15% or minus 20% bear market at the very time that vehicle bill is. So when you look at the TFSA, you're going, okay, most of it's growth, but I've got this $40,000 that's earmarked in high yield savings or GIC or something like that. So I don't have to sell anything at a loss when I need access to that money.
Yeah. Really good. All right. So how do I turn this lump sum in my RSP into income in retirement? Should I set up monthly withdrawals? Should I take out just a lump sum? And I guess we can move into from that. How do I coordinate income with my other account, like CPP, OAS, and my pensions, which is kind of a big conversation, but
but another really great question. So again, you should have a plan in place. So your retirement income plan is going to set the agenda in terms, again, your monthly withdrawals and your lump sums. And so some of you watching the video are fortunate you've got defined benefit pension plans. So a lot of your income in retirement is fixed between employer-sponsored defined benefit plan, your old age security, and your CPP. And you may not be putting a lot of pressure on your RSP RRIF accounts to supplement your income. But for many of you watching, your RSP and your defined contribution pension plan and other group benefits, that's your income, and you've got to manage that. So the first thing you want to do is we have calculators on our website where you can plug in the numbers and go, okay, if I took X dollars a year and I made X percent and I index that payment by whatever percentage, let's say 2% a year, how long will the portfolio last, right? So you can begin doing some basic calculations, and that's going to give you some guidance on what your monthly payment should be. So that's an easy starting point. And so when you're looking at the monthly withdrawals, we find most people, even if they, particularly with RRIF minimums, when a client gets to age 72 and they have this income coming out on a RRIF minimum that might be a little bit larger and it's coming out, but even before then, we find most clients prefer monthly payments. They really don't tend to gravitate towards lump sums. Very seldom. So they just go, the way I think, Shaun, is I kind of budget monthly. So if I have to take this money out or if I need to take it out, let's do it monthly. It'll go into my bank account and I'll just kind of budget accordingly. That's overwhelmingly the biggest majority. We do have some people, though, that really don't need their RRIF minimums or dollars. And so what they say is pay it out at the beginning or the end of each year. And the reason they're doing that is they have certain expenses coming up. Like we have clients that go down south or whatever. They do traveling and they'd rather get a lump sum a few months before they have to pay the Visa card or whatever to book the trips and that kind of thing. So it's very situationally specific. You want to meter out that monthly. Don't take more than you should based on your income. You don't want more life than income. So that is a bit of a calculation you do. And then the second question about coordinating with CPP and OAS or a pension, again, in our mind, you need to have a plan that really maps that out for you. So you're projecting the future, particularly for those of you who are retiring before 65. So then you're going, do I take my CPP early? Do I defer it? If I defer it, that means I'm going to put more pressure on my RSP account, RRIF account, right? So you're going to take more out in the first 5 years until you start getting your government benefits. So you have to customize the income stream from your RRIF account or RSP account to take into account that fluctuating income that's going to come into you, right? So really at the end of the day, the only way you can get true clarity on that question is sit down with your retirement planning specialist. We have information on our website that talks about our services in that area. Hire someone to give you clarity, and then you can map out your drawdown strategy from your group RSP plan, your individual plans, when to do a RRIF, what amounts need to go in the RRIF. It all gets mapped out from that plan.
Yeah, that's good. Investment options. Now, you kind of touched on this earlier with proprietary products with your group plan sponsor. But what investment options do I have after retirement? Can I keep the same investment options I had while working? And are there more flexible, low-cost options outside of the group plan?
Yeah. So the first thing that's going to happen to you, and if I go back 10 years ago, when you walk into your group benefits department or you're communicating with them and you go, okay, I'm retiring, and they're going to send you a package, and one of the forms will deal with the group plan. And in years gone by, when we help clients with that process, and often they were transferring their group plans to their personal RSP accounts that we were managing for them and with them, the major institutions like Sun Life or Canada Life, whoever was involved, the client never heard from them. They just processed the transfer forms and the money went to their personal plans. That's not the case today. So these large institutions usually work pretty hard to conserve that investment money. They really don't want to lose that money from their platform. And so they'll talk a lot about their options and low cost, low fees. And they can weave a fairly compelling story that it would make sense to keep the money with the major institution. Again, we use Sun Life. We'll beat up on Sun Life and Canada Life here. So yes, the fees could be pretty competitive, but why would you not keep the money there? Well, number one, competitive fees, that's not something that, these institutions have an advantage. I mean, clients can go directly to the Vanguards and, the BlackRock iShares of this world and get, broad-based index mutual funds or ETFs for very competitive fees that would be the same cost or lower than what your group plan is talking about. The second thing is you're never really going to get concierge customized planning from those group plans, right? So you move to the individual plan, but you're still likely dealing with a 1-800 number. You're dealing with sort of a long distance relationship that really doesn't know you. So all they're going to do is basic administration and very low level planning in terms of what's going on there. So what you need to do is just sort of think through, like, what are my end goals here? Like, cost matters for sure. If I'm kind of self-directed, then I can make those decisions. I can keep the cost low and I'm going to take control, and I want more expanded investment flexibility. And then for some of you who are you're not do-it-yourselfers, you're delegators, or you like the idea of a coaching kind of client relationship with the advisors working with you, they can get you into very competitive trusted products, but now you're getting a customized plan to help make sense of, how to invest. I very seldom see group RSP plans that are so compelling from an investment standpoint. You go, yeah, you absolutely want to keep your money there. If
Mm,
cost is the only reason, you can get low cost investments taking control of the accounts on your own.
yeah.
Um,
So this kind of leads us into the next question, which relates to fees. Now you hear a lot of advisors say, "Hey, you're in the group plan, fees are low. There's scale, so they can keep the fees pretty low." And often I've heard advisors say, like, once you transfer out and you go to an individual advisor at Canada Life or something like that, fees can go higher. So I know you kind of touched on it earlier, but will fees increase when I'm no longer part of the group plan? And is it better, I guess, to move it to a advisor?
yeah. So again, we've kind of looped around the first question.
Yeah.
You definitely can get competitive fees. The fees don't have to go higher. And whether you have it with a group plan or a personal plan, you can get very cost competitive, fees on investment products.
Yeah.
So the second point's probably a more nuanced answer. Is it better to move my funds to a personal account with my advisor, right? So if you have an advisor relationship, I guess the question I would ask are you getting good value from that advisor? Are they coaching you and providing ongoing reviews of your portfolio and giving you good direction that is just helping you with your overall wealth planning and building wealth, conserving wealth? And that's always, an assessment that is individual for every family. Because what happens is, and I'll give you a practical example. So, Josh, we've used various money managers. We use a company called Dimensional Fund Advisors, and their investment mandates are very competitively priced, around 30 basis points per year. If you look at Vanguard, they have investments that are priced at 25 basis points per year. So from an investment standpoint, the client's never going to have to pay more for security costs working with the advisor, right? Because those costs go directly to the manufacturer of the investment. But the advisor is going to charge a cost for their services. So that's when you have to do the whole kind of decision making. Is the value coming back to me from those advisor services? We've got some information that we put out in previously. It's called Advisor Alpha. And if your advisor is doing the following, number one, building a customized retirement income plan that gives you guidance on how to tax effectively generate income. Number two, developing a customized investment portfolio tied to your retirement income plan. Number three, once that investment mix is put in place, active rebalancing for that portfolio, particularly for retirees where you're trying to fill up the cash wedge once in a while, doing profit taking, year-end tax planning. There are a lot of little micro decisions that go on through the year that your advisor team is going to do with you. Building out that deaccumulation plan and making sure you're doing prudent spend down so you don't have more life than income. And then coordinating that with general estate planning discussions, tax planning discussions, and then most importantly, providing behavioral coaching, which we know in the financial, behavioral finance and coaching is one of the biggest distinguishers between families that do well from a wealth planning standpoint and those that don't. Study after study confirms that advised households have better outcomes than non-advised households. So if you think that your advisor is providing that value, then it's well worth the cost, because the cost of advice from an advisory team should be viewed as an investment that compounds financial value over and above any returns you're getting from the actual securities being put in the portfolio, if that makes sense.
Yeah, that's really good. So what happens to my group RSP if I pass away? So is my spouse a beneficiary? What taxes will apply? And what can my spouse do with the money?
So that question is part financial hygiene and then, specific question. If you haven't reviewed it in a while, make sure that you've got up-to-date beneficiary designations in your plans. If you've got a partner, make sure that they're listed as a beneficiary in the plan. So we see an awful lot of group plan statements, and people might be surprised at this, but it's not uncommon to see like no beneficiary listed. And yet, they've been married to the same person for 40 years or 30 years. Or they went through a separation and divorce and they've got a new partner, but that partner's not listed as a beneficiary. And they forgot that they had this group plan and for whatever reason, never changed the beneficiary designation. So that's the first thing. Just, pay attention to it. Make sure that the designations are there. If you have a partner, you want to make sure that they're most situations, you want them to be the listed beneficiary. And so that's the first thing. Taxes will apply. And what can my spouse do with the money? So again, with a group plan, what will happen is if you passed away, you die prematurely, and your partner is a listed beneficiary, it'll roll over on a tax deferred basis. There's no tax triggered directly into an RSP plan for your spouse. And no tax gets triggered until your spouse begins taking income from the group RSP or a group RRIF or individual RSP or individual RRIF if they end up transferring the money to their own personal account. So no immediate tax issues at all in the event of passing away. Now, if you don't have a spouse and you don't have, dependent children under the age of 18 as an example, and, older children, young adults who have mental or physical issues that create dependency. And normally what happens is those assets will go, be taxable. So there's a couple of things that can happen. Aside from your spouse, if you don't have a spouse, you can list specific people as beneficiaries on the group RSP plan. So it could be, let's say, your children. And let's say they're your adult children. So upon your death, the money gets paid directly to your kids. It doesn't have to go through the estate. It's not subject to probate, and they receive the money. Now, in many situations, you want to be careful with that. Okay, so many of you might have partners, but if you don't have a partner, you're going, well, that sounds great. It'll just be really expedient, no probate, it's quick. I'll just name the kids as beneficiaries. Well, it can create some problems, and it just really depends on your kids. If there's good communication, what needs to happen is you say to the kids, the money can be released to you, but my estate still has a tax bill. So let's say there's $100,000 of group RSP plan. I don't have a partner. I can't roll that money in a tax deferred basis to my surviving partner. It goes to my kids. It's going to be taxable. All $100,000 can go to them. But 6 months later, the executor is filing the year of death tax filing, and that $100,000 comes in as taxable income in the year of death tax filing, and it could trigger, a $30,000, $40,000 tax bill. Now the executor is looking for money to pay that tax bill. Let's say theoretically the only asset in the estate was that group plan. You've already paid the $100,000 out. So where's the money going to come from to pay the $40,000 tax bill? Well, you've put your executor in a very difficult situation. So they have to go cap in hand back to those beneficiaries. By the way, can you give me some money so I can pay CRA? And they go, no, it's gone. Like we did a nice trip last year, or well, it's in the renovation of our house, and
$100,000 trip.
well, I got two beneficiaries, right? One had a really nice trip, and the other did a nice renovation. Money got spent, and you've really created some complications now. So generally speaking, every situation is nuanced. So don't take this as advice for anyone viewing this, right? You just want to have a red flag and go, okay, I need to think through this. Normally, you want the estate as a beneficiary, right? You want the estate in a death situation where there's no partner. Money goes in the estate, it's battened down, taxes are paid, bequests are made. The residual then goes to the beneficiaries outlined under the terms of the will. Now you can circumnavigate that, right, to reduce probate costs and administration fees and other things. But if you do that, you just have to make sure everyone's on the same side of the song sheet, because if they're not, you can create some really big problems.
For sure. All right. Can I split my RRIF income with my spouse? So at what age can we split income for tax purposes, and will this reduce our overall tax bill?
Yeah, so I think it was back in 2009, the conservative government, the Harper government at the time, Jim Flaherty was the finance minister, and they brought in pension income splitting in 2009. So yes, the answer is you can split income. And so for RRIF income can be split upwards of 50% of your RRIF payments. So if I'm getting $20,000 of RRIF payments, I can push $10,000 of that to my spouse. And so the basic principle of income splitting is that you kind of divide that tax bill, and overall it could reduce the tax bite for the family. And where it's a little bit different is that if I had a defined benefit pension plan and I started getting that at age 55, I can start splitting that pension right away.
Hmm.
But with a RRIF payment, you can't start splitting it until age 65. And that's why when you look at your planning, it's important to make sure that your partner up to age 65 has other ways of generating income. And as a couple, you plan tax effectively. So when the legislation was first brought in, a lot of people thought that spousal RSPs didn't make any sense anymore because you can split the income out of the RRIF account. And the spousal RSP still makes sense. So for that period, if you don't have any defined benefit pension plans and you retire before 65, you want to make sure your spouse, if they're not working, let's say, you want to put money into a spousal plan, you'll get the deduction, but the money's in your spouse's name. And so if you retire at 60, your spouse can start drawing on the spousal plan. It's taxable income to them. You take some from your plan, it's taxable income to you. And that bridges the period between 60 and 65. Once you get to 65, 50% splitting. You don't have to worry about the spousal anymore, but you probably want to have enough money in the spousal account to bridge you for the first 5 years so you can do effective tax planning. So again, your retirement plan, if you hire someone to do that, it'll kind of give you guidance, right? You don't need to put a ton of money in the spousal plan, but enough to do effective tax planning. And then once you get to 65, income splitting is a lot easier.
Yeah. All right. So,
Oh, and one more point. Will
Yep.
it reduce your overall tax bill? Absolutely. When we saw the legislation come in 2009, like I was seeing $4,000, $5,000, $6,000 of tax savings for families immediately, right away, because of the income splitting.
Yeah. So should I take money out before converting my RSP or group RSP to a RRIF? Is there any benefit to that? Would it be tax efficient to withdraw some funds? And can early withdrawals help with reduce OAS with clawback?
Yeah. So again, another good question, and I keep going back to the planning, but it's very precisely answered when you do forecast for clients in retirement. But would it be tax efficient? Well, you sometimes hear about the meltdown strategy, RSP, RRIF meltdown strategies on the YouTube videos. That's kind of what they're getting at, is that maybe it makes sense, even if you don't need the money, maybe it makes sense to pull money from the RSP or from a RRIF account before age 72, because if you don't, you might create a bigger tax issue for yourself down the road. So we'll pull the money out, pay the tax, maybe push that money into my, the TFSA account, push it into a non-registered account, because you may not need all that income. So for some clients, it actually definitely does make sense to pull money out before you have to for tax planning reasons.
Yeah.
And that can help to reduce future old age security clawbacks. Again, it's not super common in many situations. You're tipping over close to $100,000 a year individually before you're sort of seeing impacts on clawback. So, there's not a ton of retirees in that situation, but it does happen for sure. And so as you project into the future on the retirement income plan, you can see whether there's the potential of that happening. So that could be another secondary reason for pulling money out. So it keeps the income payments at age 72 from ballooning, right? And clawing back some of that old age security benefit for you.
Yeah. Awesome. All right. So that's most of the questions that I have. I don't know if there's anything you wanted to touch on before we close out here, but
Yeah, I think that the main thing to keep in mind is you've got lots of flexibility. Our experience has been group plans with the major carriers are not typically super compelling. There's nothing really unique about them other than maybe they'd be cost effective. Yes, they've got a range of investment options, but you're going to have way more control and flexibility if you have a self-directed account or deal with an advisor. And then number 3, they're not going to do a very good job of coordinating the income and planning piece, right? You're going to be on your own there. So what we find is that, sometimes people will leave it there and then they call a 1-800 number. They're trying to get service on the accounts, and it's never a really super great situation. You almost always see people eventually migrating their assets from a group plan let's say with Canada Life, then a personal plan with Canada Life, and then they're trying to get servicing and trying to coordinate with their other assets, and eventually they go, okay, that's it. I'm going to move it to my own personal account. So that's typically what we see eventually.
Yeah. All right. Awesome. Well, thank you for watching. If you're watching and going, hey, I don't have clarity on my own plan, or I'm about to retire, I don't have a plan, make sure you go to our website. You can shoot us a submission form and schedule a free 30-minute meeting, and we can talk through whether our services might be able to help you. And so, yeah, thanks for watching. We'll catch you in the next video. Take care.